Futures and options are inherently risky and not suitable for all investors. Only risk capital should be used. An investor may lose more than the original investment. Past performance is not necessarily indicative of future results.
All right, well, it's Thursday, April 5th, and I know we talked briefly last recording, and I gave you some prices to use in the bonds and notes, which I think were pretty much taken out by noon Friday. And I'm going to give you some more prices here to keep watching, but to me there's an important point with this, because the thing with futures trading is you want to have a game plan of what you think the market is going to do. And of course, if it does it, you can trade more size, have more confidence with your trades, that type of thing. But if it doesn't, you can't impart your thought on the market. All right? So the market made a big breakdown. You can't keep saying, well, wait a minute, he says bullish, I'm going to try and buy this and buy it and buy it. You can't. All right? Now, I got to keep this kind of short, but I want to give you some prices to keep looking at in bonds and 10 years. Now, bonds, when we started this recording, we were trading around 138.06, 07. You guys that are real bearish and want that last price where the last bull tries uncle and the market is weak, you're talking about 137.06. Conversely, you guys want that ultimate price to the upside where the last bear is done, it's 139.26. All right, now over to 10-year notes, all right, and I'll try and get this through real quick. The last price that the bulls are done, okay, you're talking down at 128.25 half. That's where they're done. The last price where the bears are done and the market is just bullish and up and away is 130.02 half. All right, so I'm going to leave you with that. And remember, you know, futures trading is short-term trading. You want longer-term stuff, you use options. That's why I'm up here talking on that. All right, so options.
All right.
What do you got for us?
Well, first of all, as always, Jack, options trading, not suitable for everybody.
I know that.
You're writing naked options, you can lose more than your initial investment.
You told me that last week.
I'm going to tell you every week, too, okay? So make sure this is suitable, okay? There is a risk of loss. That being said, normally on a Thursday ahead of the non-farm payrolls number, I'd be looking at potentially selling some premium in the bonds. However, this week's a little bit different, and I'm going to just kind of sit and watch. And the reason is, number one, we have very short trading hours tomorrow. You know, the bond's trading a couple hours. Most of the markets are closed for the Good Friday holiday. So you don't necessarily want to go in there and be sticking your neck out in an illiquid, low-volume environment like this.
Makes sense.
Number two, we have the Eurozone situation heating up again. And I've spoken to buddies, I know you have, and a lot of the larger players are getting concerned again right now after that lousy Spanish auction. So right now, I think you want to err on the side of caution, if that makes sense. Now, speaking of the bonds, you know, you talked briefly about that big drop we saw. Okay, now what I'm looking at, we went down and tested that key price around 135.04. Since then, the bonds have come back up and retraced about half of that down move, a little more than half. Okay, but they look a little gassed up here, and I know a lot of people think they're likely to roll back over because Bernanke did not indicate a QE3, the Fed doesn't want to print more money right now, et cetera, et cetera. So I'm going to give you a limited risk way to play some downside here in the bonds using options, okay? The trade is this. It's purchasing the June bond 138-133 put spread, okay? So you're going to buy the at-the-money 138 put. You're going to sell the out-of-the-money 133 put, okay? You're going to look to purchase this spread for 132 or better, which in the bonds equals a $1,500 premium plus commissions and fees, okay? Because it's a spread, it's two contracts, you're going to have two sets of commissions and fees. As always, you want to factor that into any potential profitability. Now, the way the trade works, if the bonds roll back over, okay, at expiration, if the bonds are under 133, that spread will go to full value. Now, being a 5-point spread, each point in the bonds is $1,000. The max value of that spread is $5,000, okay? So the most your $1,500 investment can turn into is $5,000, okay? Anywhere in between at expiration, just do the math. For instance, if we're at 135, okay, that spread's gonna have 3 points of intrinsic value. So it'd be 3,000 minus the 1,500 premium, factor in your commissions and fees as well, okay? The important thing to remember is you cannot lose more than the premium paid plus your transaction costs, and it gives you some exposure to that downside in case the bonds wanna go down there and retest that key price again.
All right, I like it.
All right.
All right, thanks.